Good morning friends, today is 9th of October 2022 and here is a very interesting article on credit default swap. Here Ram will ask questions and we as an individual have in our mind, and Veena will answer to the queries. So from the video we'll come to know about what credit default swap is and what impact can a bankruptcy of bank can have in the global economy. So Ram wants to know what credit default swap is and how it works and how can an agency make profit from someone defaulting. To which Veena answers that, let's say for example there are two parties, a private limited company, say for example Hindustan Unilever, and you as an individual. So Hindustan Unilever, if in case it wants 1 lakh rupees, it will issue a bond of 1 lakh, and you as an investor will buy the bond and give 1 lakh to the company. In return, the company will pay you some interest rate for some particular year. Now, if there is a news that Hindustan Unilever is not doing well, so in fear or apprehension that your 1 lakh rupee will be lost, you will go to an insurance company or to a bank or NBFC, which will be typically selling a CDS, that is, which will be selling credit default swap. It's again like a document in which it's written that you have to pay a premium, and in return the insurance company will pay you 1 lakh in case the Hindustan Unilever defaults. So basically you swap the contract between you and Hindustan Unilever with you and the insurance company. So it's because you are swapping it's called the credit default swap. Now this credit default swap can be used as a speculative instrument as well. When there are lots of credit default swap, you can sell the one in which you feel the borrowing company will not default, and so thus you can earn premium. And you can buy CDS when you feel that the company will default. So the next question which Ram asked is that recently there was a news about a major bank defaulting in Europe, and on that day the Indian market was down. So what was the reason behind the Indian market being down? To which Veena answers that when banks default, the depositors can't withdraw money, meaning there is liquidity crunch. So for smooth functioning of the market, sufficient liquidity is required. In practical life, let's say example, you are running a factory and then you have an account with Yes Bank, and suppose today you need some amount of money, let's say 1 crore rupees, to buy raw material for your factory. So you go to the bank, Yes Bank, in order to withdraw the money. And if the Yes Bank says that no, it's going to default, it can't pay you 1 crore rupees, so what will happen on that day? You can't buy the raw material and then your factory will be closed for the day. So bank defaulting will impact your business. And so in this case, if lots of business get impacted, the economy gets impacted too. So what happens happened in Europe is that when in an economy a bank defaults, the market participants gets worried, and so they wants to keep the money as a cash with themselves instead of investing in the capital market, like investing in equity shares. So if they don't invest in equity shares, the demand for the equity will fall. Like the investors in Europe, if the European bank defaults, they will start keeping money with themselves in cash instead of investing in some other equity markets. Like the European people, they will not be investing in the Indian market because they have a fear, they are nervous that they will need cash anytime, so they will not invest. Thus the demand for equity in India will fall, and so its prices for the shares will also fall, and thus the companies in India which used to borrow money from the equity market will suffer from this liquidity crunch. Thus we can see the repercussion effect that a bank defaulting in Europe can have an adverse impact on our Indian economy. So this was all about this was a very interesting article on credit default swaps. I hope you liked it.